and welcome to Two Shop with ET. I'm Nisha Poddar. The two big news developments today that you must know about. Trump's tariff tsunami, the implications for India as well as the world, and how does the global market really react to the US tariff announcements and what could be the impact. President Donald Trump has initiated the sweeping import duties that are really shaking up the global trade. We were bracing up for this. Now, this is the boldest tariff move since the 1890s. What does this mean for India as well as the global market? Well, it's a bombshell announcement for the world. On 2nd April, President Trump has announced a 10% baseline tariff on all US imports set to take effect from 5th of this month. Now, starting April 9th, remember the US will impose individual reciprocal tariffs on countries with large trade deficit with America. Now, according to some of the brokerage reports, let's highlight. HSBC says that this action impacts $3.3 trillion worth of imports, making it the largest tariff action in US history. So, who's affected and by how much? Let's take a look at that. India faces 26% tariff hit while China faces a 54% hit. So a US calculated India's effective import duties at 52%, including VAT and also currency policies. So Trump imposed a tariff of 26%, half the calculated rate. China faces a reciprocal tariff of 34% on top of existing 20% duties, totaling 54%. Vietnam faces 46% and Thailand 36%. According to Bernstein, these are not mild tariffs. They are really sweeping as well as aggressive. So what does this really mean for India? Let's take a look at that. There are some impacts but also some insulations to feel good about. Bernstein notes that India's top exports, the IT services as well as the pharmaceuticals, are exempt from these tariffs. Jeffries suggests that India's pharmaceutical stocks could really see a short-term rally as the White House is likely to avoid tariffs on generics to keep the drug costs low. Now, IT exports are not directly affected, but may be at risk due to a potential slowdown in the US discretionary spending, and that's, remember, our very big business. Sectors like auto parts and as well as apparels will face higher duties. However, India is better positioned than competitors like Vietnam, which faces harsher tariffs. So what's the wider global impact? Let's take a look at that. Recession concerns arise. HSBC projects that if these tariffs really remain in place, world export growth could decrease from 2.9% in 2024 to 1.3% in this year. According to Goldman Sachs, the US effective tariff rate could rise by 18.8 percentage points, thus increasing inflationary pressure and also raising the risk of a recession. Nomura terms this a risk-negative event, particularly for Asia's manufacturing exporters, and also warns of pressure on earnings as well as the margins. Let's see the market reaction. Nomura recommends a defensive investment strategy focusing on sectors such as telecoms, consumer staples, even hospitals, and real estate investment trusts like REITs. Bernstein, that downgrades Indian IT stocks to equal weight due to US recession risks, while also upgrading the healthcare sector for its immunity from the tariffs. Take a look at Jeffries, which also expects a relief rally in the Indian pharma stocks due to their clarity as well as exemption status. So the big question, negotiation or escalation? There are only two ways. Unlike some of the countries, India is unlikely to retaliate. Bernstein states that the focus is on bilateral talks and working towards a trade agreement in the second half of this particular year. HSBC reports that countries like Australia will not impose countermeasures. Still, EU may respond soon, particularly regarding the previously imposed steel as well as aluminium tariffs. However, the White House has warned that they are not looking at retaliation and it will only lead to further escalation. So let's take a look at the market reaction globally across all asset classes. There was enough volatility globally, raising concerns amongst the investors. And the US market response has been that of decline of the stock futures. The Dow Jones futures fell by over 2%, S&P 500 dropped by over 3.5%, and Nasdaq over 4.5%. So this decline really reflects the investors' anxiety about potential economic disruptions that this has caused. On the Asian markets front, Japan's Nikkei fell by approximately 2.8%, reaching its 8-month lows as investors reacted to the increased tariff on Japanese exports. The broader Asian impact also saw losses, particularly in some sectors like the sectors of technology as well as the automotive sector, which, remember, rely heavily on the US exports. European markets, they dropped, especially in the healthcare sector, which has hit its lowest point since the month of December. Now, the European Commission president describes the tariffs as a major blow to the world economy. They have been all along vocal. They've warned that they could really lead to higher consumer costs and a potential global recession. On commodities as well as the currency market, let's take a look at that. So the decline in oil prices is a big headline. Brent crude fell to $73.35 per barrel after dropping as much as 3.2% earlier. Now, this marks the largest daily percentage decline that we have seen in Brent crude since March 5th. Now, the surge in gold prices is another big headline. It's at record highs, surpassing $3,100 per ounce, as investors really sought safe haven approach and this asset class amidst market volatility. We also see currency fluctuations. The US dollar experienced fluctuations reflecting investor uncertainty, while currencies of export-resilient countries faced downward pressure. So this was the picture on the currency front. So taking note of overall investor sentiment and their various asset classes, the analysts are concerned that these tariffs really could lead to slow growth globally in the economic front, increase the risk of recession, and also raise living costs. With that, it's a wrap for now from Too Sharp with TT. Thanks so much.